On July 4th, 2025, lawmakers passed the One Big Beautiful Bill Act, an 870-page economic package that touches nearly every aspect of your financial life: income taxes, Social Security, Medicare, estate planning, and much more. While this bill has sparked intense political debate in recent months, I am not here to share my personal opinions or take any sides. My goal today is to save you from reading 870 pages of Congressional jargon and clearly and objectively outline how this bill affects your hard-earned retirement dollars. So to do that, in today's episode, I'm sharing the 5 biggest things retirement savers need to know about the One Big Beautiful Bill. I'm also sharing a handful of miscellaneous provisions that will apply to a smaller percentage of listeners, but are still interesting, important, and helpful to understand. There's good news, bad news, and a few confusing twists along the way that could dramatically affect your financial situation. So grab some coffee or something stronger if you need it, and let's break it all down. Welcome to another episode of the Stay Wealthy Retirement Show. I'm your host, Taylor Schulte, and every week I tackle the most important financial topics to help you stay wealthy in retirement. And now, on to the episode. Okay, before we dive into the weeds, I want to share 2 important notes with you. First, the One Big Beautiful Bill, which I'll mostly just refer to as the bill going forward. The One Big Beautiful Bill identifies some law changes as permanent and others as temporary with specific end dates. Just know that permanent doesn't necessarily mean permanent, and a change can in fact be made by a future administration and an act of Congress. Second, this bill is massive, and if you can't already tell, is also massively confusing. In fact, there are still many areas of this new legislation that are causing confusion in the planning community and will require additional clarification from the IRS. So while I'm doing my absolute best to provide accurate information to you today, please note that some interpretations could change and that you should consult with your trusted advisors before taking any action. Okay, with that out of the way, let's dive into the 5 biggest things that retirement savers need to know about this new bill. First up, the current reduced tax brackets and increased standard deductions have been officially extended. As a refresher, in 2017, the Tax Cuts and Jobs Act lowered federal income tax rates across the board and increased the standard deduction, among many other things. These tax cuts and increased standard deduction amounts were not permanent and were set to expire at the end of this year unless action was taken. Well, action was taken, and the One Big Beautiful Bill removed the expiration date and permanently extended the current federal tax brackets and higher standard deduction amounts. In addition, starting this year in 2025, there is a small increase to the base standard deduction. Specifically, if you are married filing jointly, the standard deduction this year is $31,500, up from $30,000 in 2024. If you're single, the standard deduction is half that amount, or $15,750. And we don't want to leave out those who file as head of household. Your standard deduction this year is $23,625, up from $22,500 in 2024. Lastly, there is still the additional standard deduction available to individuals age 65 and older, although the new bill did not change or increase that amount. Specifically, those who are married filing jointly can claim the additional standard deduction of $1,600 per spouse who is age 65 or older as of the end of the year. So $3,200 in total if both spouses meet the criteria. For a single filer who is age 65 or older as of the end of the year, the additional standard deduction amount is $2,000. Putting this all together, a couple who is married filing jointly and both age 65 or older by year end will be eligible to take the increased standard deduction of $31,500 plus the additional standard deduction of $3,200 for a grand total of $34,700. And yes, as some of you might be aware of, there is another bonus deduction for seniors that has led to quite a bit of confusion. I'll address that deduction shortly because it's somewhat connected to the second major change to share with you, or rather the absence of change, which is that Social Security, unfortunately, will continue to be taxable. Now, to be more accurate, since it is possible for some people to avoid taxes on Social Security, to be more accurate, the One Big Beautiful Bill did not eliminate federal taxes on Social Security benefits as many had hoped. The IRS will continue to use the same formula that it's used for the past 40 years to determine how much of your Social Security is taxable, which, depending on your income, can be anywhere from 0% to 85% of your benefit. And unfortunately, the income thresholds for the Social Security taxability formula have not been adjusted for inflation throughout the entire 40-year period. As discussed on this show before, this lack of an inflation adjustment acts as a sort of phantom or hidden tax that has slowly made more and more Social Security income taxable over the past 4 decades. Now, while no changes were made to the Social Security taxability formula, the new bill does attempt to make up for this lack of change by introducing what many are referring to as the senior bonus deduction, which is the third big item to share with you. Here's what you need to know. This new senior bonus deduction is $6,000 per person, $12,000 for married couples, and is only available to taxpayers aged 65 or older. And contrary to what many people initially thought, this bonus deduction can in fact be added to the standard deduction and the existing additional standard deduction for people age 65 and older that I spoke about in change number 1. In other words, if you are age 65 or older by the end of this year, all 3 of these deductions can be combined. Even better, this senior bonus deduction can be applied whether you take the standard deduction or itemize your deductions. But to keep the math simple, let's use a married couple filing jointly who is age 65 and taking the standard deduction this year as a quick example. In 2025, they will get the increased standard deduction of $31,500. They will also receive the existing additional standard deduction for people age 65 and older of $3,200. On top of it all, they will also now receive the new senior bonus deduction of $12,000, bringing their total deduction amount to $46,700. Now, unlike the normal standard deduction, this new senior bonus deduction is not a permanent feature of the bill and will only be available until 2028. In other words, you have 4 years to take advantage of this deduction and the planning opportunities that it presents. Lastly, before we move on, it's important to note that this new senior bonus deduction does begin to phase out at $150,000 of modified adjusted gross income for joint filers and $75,000 for single filers. More specifically, it's reduced by 6 cents per dollar over those phase-out limits and is completely eliminated if modified adjusted gross income exceeds $250,000 for joint filers and $175,000 for single filers. By the way, I know this can all be a bit overwhelming, so if you're having any trouble following along with some of the various deduction amounts and phase-out limits, I've got good news for you. Tyler Aubrey, lead planner and partner at my firm, just published an in-depth, very easy to read article covering everything I'm discussing today and more. To check it out, just head over to the show notes page for this episode, which you can find by following the link in the episode description right there in your podcast app, or by going to youstaywealthy.com/246. Okay, sticking with good news, the fourth big change to share with you today is that the SALT cap has been temporarily increased. As a refresher, the SALT deduction stands for state and local tax deduction, and it allows for taxpayers to lower their federal taxes by deducting some of the money they paid for state and local taxes, like property or income taxes. Prior to the big, beautiful bill, the SALT deduction was capped at $10,000, which didn't provide much of a benefit for individuals in high tax states. But starting in 2025, the SALT deduction cap will temporarily increase to $40,000 for individuals with a modified adjusted gross income below $500,000. If your modified adjusted gross income exceeds $500,000 this year, the SALT deduction will gradually phase out until it's reduced back down to the original $10,000 cap. Specifically for the tax nerds that are out there, it's reduced by 30% for every $1 over the $500,000 Maggie threshold. Lastly, similar to the senior bonus deduction we just discussed, this SALT cap increase is not permanent and is set to end after 2029. In 2030, it will revert to the $10,000 cap unless a future Congress takes action. Okay, the fifth change to share with you today, or once again, the absence of one, goes in the unfortunate news column, and that is that contributions to an HSA are still not permitted for Medicare enrollees. And this was a big disappointment because, as some might recall, the House version of the bill did actually propose this long-awaited change to allow individuals on Medicare Part A to continue contributing to health savings accounts, commonly referred to as HSAs. Unfortunately, this provision was removed in the final version of the bill, which means once an individual enrolls in Medicare, they are unable to continue funding an HSA, even if they're still working and even if they're still covered by an employer's high deductible health plan. That being said, there is one workaround to share with you, which is that a working spouse who is not yet eligible for Medicare and is also covered by a high deductible health plan is actually eligible to make a family contribution to an HSA, which in 2025 is $8,550. That person can also make an age 55 plus catch-up contribution in the amount of $1,000, but only to an HSA in their name. Catch-up contributions to an HSA for the Medicare enrolled spouse are not permitted. Okay, that wraps up the 5 big changes retirement savers need to know. But before we part ways today, I want to quickly run through a handful of other provisions in the bill that might apply to a smaller percentage of our listeners, but are still important to know about. The first is a permanent extension of the increased lifetime estate and gift tax exemption amounts. As a refresher, starting in 2018, the Tax Cuts and Jobs Act doubled the lifetime exemption for estate and gift taxes compared to previous years. However, this increase was temporary and set to revert back to the original levels in 2026 unless action was taken. Well, action was taken as part of the One Big Beautiful Bill, permanently extending the higher exemption levels. Additionally, starting next year in 2026, there will be another small increase to the exemption amount. For some context, the current lifetime estate exemption in 2025 is $13.99 million per person and would normally increase with inflation each year. So under normal circumstances, we would expect the 2026 exemption to jump to somewhere around $14.5 million as a result of this inflation adjustment. However, as a result of the new bill, starting in 2026, the lifetime exemption will actually increase to a flat $15 million per person, which will then, from that point forward, continue adjusting upward each year based on inflation. And again, this increase to the lifetime estate and gift tax exclusion was made permanent with no end date. Next, the existing mortgage interest deduction amounts were extended and have now been made permanent. More specifically, if you have a mortgage on a first and or second home and itemize your deductions, the mortgage interest deduction remains limited to a principal amount of $750,000. In other words, any interest paid on principal mortgage balances that exceed the $750,000 threshold is now permanently non-deductible. The next change to quickly share is a permanent additional deduction for charitable contributions for taxpayers who are taking the standard deduction. Historically, charitable contributions were only deductible for those who itemize on their tax return. But starting next year in 2026, a married couple filing jointly can claim a deduction for up to $2,000 of charitable donations, and a single filer can claim $1,000. There are no income phase-outs, which is great, but there are also no inflation increases, which will reduce the benefit of this welcome change over time. Sticking with charitable giving here, if you itemize your deductions, the new bill has also changed how much of your charitable donations can be itemized. Specifically, starting in 2026, your itemized charitable contributions must exceed 0.5% of your adjusted gross income to become deductible. For example, let's say your adjusted gross income in 2026 is $200,000 and you donate $1,000 to charity. Well, $200,000 times 0.5% is $1,000. So according to this new tax rule, you would not be able to itemize and deduct that $1,000 donation since it does not exceed 0.5% of your adjusted gross income. As another example, let's say you have the same $200,000 of income, but you instead donate $2,000. In that scenario, you would only be able to itemize and deduct $1,000, the amount above 0.5% of your adjusted gross income. Okay, the second to last change to share with you is the temporary deduction of car loan interest. This is effective starting this year in 2025 and goes through 2028. So you have 4 years to take advantage of it. In short, up to $10,000 of interest on car loans can be deducted from your income. However, this deduction only applies to new personal use, non-business cars that are assembled in the United States, and lease financing is not eligible. The deduction is also subject to a phase-out of 20% for every dollar above a modified adjusted gross income of $200,000 for married individuals filing jointly and $100,000 for single filers. This phase-out means that the deduction is reduced down to zero if income reaches $250,000 or more for married couples filing jointly and $150,000 or more for single filers. Last but not least, I want to quickly touch on the confusing Trump savings accounts. While more clarification from the IRS is still very much needed, in short, these Trump accounts are essentially traditional IRAs used to accumulate retirement savings for minors. The investments in the account grow tax deferred like an IRA and are taxed as ordinary income when money is withdrawn at age 18 or older. Annual contributions, which are not permitted to begin until next July 4th, 2026, are capped at $5,000 per year until the child reaches the age of 18. The government will also be making federally funded $1,000 contributions each year to accounts in the name of U.S. children born between 2025 and 2028. Children born before 2025 are still eligible for the account, but do not receive the federally funded contribution of $1,000 each year. Although well-intentioned, this new savings account has significant drawbacks. For example, contributions are not tax deductible, and distributions, as mentioned, are taxed as ordinary income as opposed to the often more favorable long-term capital gains rates. There's still more to learn about these accounts, but on the surface, many of us planners are scratching our head trying to uncover how beneficial they really are. As you can tell, there is a lot to unpack in this bill, a bill that emerges during a time when it's challenging to find clear, objective information without politics muddying the picture. The reality is that ugly politics has been a prevalent theme throughout history, and we can either make educated and informed decisions in response to law changes, or we can get caught up in the noise that's hammering our eardrums and eyeballs at every turn. Personally, I suggest the former and recommend focusing on what you can control and focus on working with your trusted advisors to understand exactly how these changes impact your retirement plan and how you can take advantage of new opportunities. If you have any questions as you digest everything, or think I missed something critical that our listeners need to know, or you think I got something wrong, please don't hesitate to send me an email at podcast@youstaywealthy.com. To view the research and articles supporting today's episode, including the entire 870-page bill and the in-depth article written by lead planner and partner of my firm, Tyler Aubrey, just head over to youstaywealthy.com/246.
This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. This podcast is not engaged in rendering legal, financial, or other professional services.